Avoid these 10 common investing mistakes and you'll be on your way to make millions. Want to make your money work for you? Avoid these mistakes. Investing can be a great way to grow your wealth, but it's easy to make mistakes. Let's dive into the top 10 mistakes you should avoid. By the end of this video, you'll be better equipped to make sound investment decisions and grow your wealth more effectively. One of the biggest mistakes investors make is diving into the market without a clear plan. Having a well-thought-out investment plan is crucial because it acts as your roadmap, guiding your decisions and helping you stay focused on your long-term goals. Without a plan, you're more likely to make impulsive decisions based on short-term market fluctuations.
Imagine setting out on a road trip without a map. You'd likely get lost, take wrong turns, and waste time and resources. The same applies to investing. A clear plan helps you determine your risk tolerance, investment horizon, and financial goals.
Creating an investment plan isn't as daunting as it sounds. Start by assessing your financial situation and defining your goals. So, take the time to create a solid investment plan and stick to it. Diversification is a fundamental principle of investing, yet many investors overlook its importance. By spreading your investments across different asset classes, industries, and geographical regions, you can minimize risk and enhance your potential for returns. Ignoring diversification can leave your portfolio vulnerable to market volatility and specific sector downturns.
Think of diversification as not putting all your eggs in one basket. If one investment underperforms, others in your diversified portfolio can help offset the losses.
To achieve diversification, consider investing in a mix of stocks, bonds, real estate, and other asset classes. You can also diversify within each asset class by investing in different sectors, industries, and companies of varying sizes. While diversification doesn't guarantee against losses, it is a proven strategy for managing risk and improving the resilience of your portfolio. So take a close look at your portfolio and ensure it's well diversified. Trying to time the market is a common mistake that even seasoned investors can fall into. The idea of buying low and selling high sounds appealing, but predicting market movements with precision is incredibly challenging and often leads to losses. Instead of trying to time the market, focus on a long-term investment strategy.
Market timing involves making investment decisions based on short-term market predictions, which can be influenced by various factors, including economic data, geopolitical events, and investor sentiment.
Research has shown that missing just a few of the market's best days can significantly impact your overall returns. By staying invested and maintaining a long-term perspective, you can benefit from the market's overall upward trend and avoid the pitfalls of short-term volatility. Dollar-cost averaging is a strategy that can help you avoid the temptation to time the market. By staying invested and maintaining a disciplined approach, you can navigate market volatility and achieve more consistent and reliable returns. Being aware of these fees and minimizing them can help you keep more of your hard-earned money. Consider this. Even a seemingly modest fee of 1 to 2% can add up to a substantial amount over the years, especially when compounded. Market analyst. High fees can erode your investment returns and make it more challenging to achieve your financial goals. One way to minimize fees is by choosing low-cost investment options such as index funds and ETFs. These funds typically have lower expense ratios compared to actively managed funds, as they aim to replicate the performance of a specific index rather than trying to outperform the market. Market analyst. It's also essential to be mindful of trading costs. By being proactive and minimizing investment fees, you can enhance your overall returns and achieve your financial goals more efficiently. The herd mentality can be a dangerous trap for investors. Following the crowd and making investment decisions based on popular trends or the latest market buzz can lead to poor outcomes. Investor 3. Instead, it's essential to conduct independent research and make informed decisions based on your own financial goals and risk tolerance. Investing based on hype and speculation can lead to overvalued assets and significant losses when the trend reverses. Independent research involves analyzing the fundamentals of an investment, such as its financial health, growth prospects, and competitive position. This due diligence helps you make more informed decisions and avoid the pitfalls of following the crowd. By making informed decisions based on your own analysis, you can achieve better investment outcomes and stay on track to meet your financial goals. Emotions can be a powerful force in investing, often leading to irrational decisions and poor outcomes. Emotional investing involves making decisions based on fear, greed, or other emotions rather than rational analysis. Recognizing and managing your emotions is crucial for making sound investment decisions. Fear can lead to panic selling during market downturns, locking in losses. Greed can drive investors to chase high-flying stocks, leading to significant losses. Stick to a well-defined investment plan to manage emotions. A clear strategy helps you stay disciplined and avoid impulsive decisions. Regularly review your plan and focus on long-term goals for stability. Manage your emotions to avoid pitfalls and achieve better financial outcomes. Rebalancing your portfolio is an essential practice that many investors neglect. Over time, the performance of different investments can cause your portfolio to drift away from its original allocation. Regularly rebalancing ensures that your portfolio stays aligned with your risk tolerance and financial goals.
For example, if your target allocation is 60% stocks and 40% bonds, and the stock market performs well, your portfolio may become overweight in stocks. Rebalancing involves selling some stocks and buying bonds to restore the original allocation.
The benefits of rebalancing are twofold. It helps manage risk and encourages a disciplined approach. Investing in assets you don't fully understand can be a recipe for disaster. It's essential to thoroughly research and understand your investments before committing your money. This knowledge empowers you to make informed decisions and avoid potential pitfalls. One common mistake is investing in complex financial products without grasping their underlying mechanics and risks. For example, derivatives, leveraged ETFs, or certain alternative investments can be highly complex and carry significant risks. If you don't understand how they work, it's best to steer clear or seek advice from a knowledgeable professional.
Understanding your investments also involves analyzing the fundamentals of the companies or assets you're investing in. This includes evaluating their financial health, growth prospects, competitive position, and industry trends. By conducting thorough due diligence, you can identify quality investments and avoid those with red flags. By understanding what you're investing in, you can make more informed decisions, manage risks effectively, and achieve better outcomes.
Taxes can have a significant impact on your investment returns, yet many investors overlook the importance of tax-efficient investing. Understanding and managing the tax implications of your investments can help you keep more of your hard-earned money. One common mistake is not taking advantage of tax-advantaged accounts such as IRAs, 401(k)s, or Roth IRAs. These accounts offer various tax benefits, such as tax-deferred growth or tax-free withdrawals, which can enhance your overall returns. Maximize your contributions to these accounts to take full advantage of their benefits.
Another important consideration is the tax treatment of different types of investments. For example, long-term capital gains on assets held for more than a year are typically taxed at a lower rate than short-term capital gains. Holding investments for the long term can help you benefit from these lower tax rates.
Tax loss harvesting is another strategy to consider. By understanding and managing the tax implications of your investments, you can enhance your overall returns and achieve your financial goals more efficiently. Patience is a virtue, especially in investing. A lack of patience can lead to impulsive decisions, such as selling during market downturns or chasing short-term gains. Understanding the importance of long-term thinking is crucial for achieving successful investment outcomes. Investing is a journey, and it's essential to stay committed to your long-term goals. Market fluctuations and short-term volatility are inevitable, but they shouldn't derail your investment strategy. Instead of reacting to short-term market movements, focus on the bigger picture and the long-term potential of your investments.
One of the key benefits of long-term investing is the power of compounding. By staying invested and allowing your returns to compound over time, you can achieve significant growth. Compounding is the process of earning returns on both your initial investment and the returns generated over time. By staying patient and committed to your strategy, you can navigate market volatility and achieve more consistent and reliable returns.
If you found this video helpful, make sure to like, subscribe, and hit the notification bell for more investing tips. Avoiding these common investing mistakes can significantly enhance your financial journey and help you achieve your goals more effectively. By staying informed, disciplined, and patient, you can navigate the complexities of investing with confidence. Thank you for watching, and remember, smart investing is all about making informed decisions and staying committed to your long-term goals. See you in the next video.